Welcome to the Fast Five by Fear and Greed. I'm Michael Thompson, and good morning, Sean Aylmer.
Morning, Michael.
Today, in just 5 minutes, we're looking at what will happen this year for the large cap stocks. These are the companies that everybody knows that really dominate the local market. Think the banks, the big miners, that kind of thing.
That's right. 2021 saw a few changes in the rankings of these companies. Westpac, for example, bounced around a bit, lost its position as the second largest bank. Plenty of action outside as well. Mining stocks moved around a lot. Roger Montgomery is the founder and chief investment officer of Montgomery Investment Management. Roger, morning.
G'day guys, good to be with you.
So the large caps are often household names. Is that a good or a bad thing? Because, some investors would just jump into these large caps, perhaps without kind of thinking of the full spectrum of opportunities.
Yeah, look, one of the mistakes, if I could be so bold as to suggest that people make mistakes, one of the mistakes that's often made is that the bigger companies are safer. And it's not really true. You hear the word defensive bandied around quite a bit when it comes to large companies. And I think the only truly defensive company is a company that's growing. You want a business that's going to be bigger in the future than it is today. And your job as an investor, I think, is a fairly simple one. You just want to buy a business that you are fairly confident or very confident is going to be significantly bigger in 5, 10 or 20 years from now, and you just want to buy it at a reasonable price. The problem with a lot of the big companies is that many of them are mature. They've enjoyed that S-curve some time ago, that S-curve of growth. And so now they're at that sort of top of the S where it sort of flattens out. And really then in order to make decent returns from these businesses, what you have to do is they have to make acquisitions. That's often fraught with danger. They have to make those acquisitions at a reasonable price to give their shareholders a good return. And they can sometimes management can sometimes succumb to the desire to grow by any means possible. And that can be dangerous and that can destroy capital. So there's some of the things that you need to be mindful of when you're investing in big caps.
Okay, I just want to mention a few that over the past 12 months have done really well and kind of gone from the mid to more or less the big cap level. Aristocrat Leisure being one, James Hardie, South 32. They've all outperformed. Are they likely to keep running, or are we going to just keep seeing, because the market is, of course, full of banks and miners and big retailers, but those other ones, how do you think they'll perform?
Well, we own Aristocrat, and so we've been very pleased with its performance. It's done extremely well, and that's partly because as it benefits from reopening, that process is taking a long time. So the anticipation around the reopening has been persistent, and that's really helped. We think the leadership in the big cap space will constantly evolve and change. But you're right to point out that businesses that start out small and become big are some of the more exciting stories. One that you didn't mention in that list that I think is really interesting is actually REA Group. Yeah. So REA is one of the highest quality businesses listed on the Australian market. It's up there with Reece and ARB, and there's a small bunch of businesses that CSL and Cochlear, another two. We think they're excellent businesses. But with REA, what's interesting about that business is that they have generated double-digit growth in their revenue and earnings over many, many years, despite the fact that in Australia, the total number of properties listed has been declining for about a decade. Now we're at the point where listings are starting to go up. And so even though the company's been making more money as listings have gone down through cost cutting and becoming more efficient, that's a business that will actually see a lot of profit generated as listings increase, because all of that extra money just drops to the bottom line. And so that's why the share price has gone from circa $90 a year or a bit more than a year ago to about over $160 more recently.
We can't talk about large caps without at least mentioning the banks. What do you think the prospects for them for the next 12 months or so?
Yeah, look, they've run hard. They had a really good run early last year. Then it got very tough for them on their margins, and their net interest margins declined. The reason why their net interest margins declined is there was a lot of pressure on funding. Banks make a lot of money when interest rates are high. They make a lot of money when the yield curve is steep, and the yield curve is the plot, if you like, or the chart that plots the difference in interest rates between the short-term interest rates and the longer bond rates. When that's really steep, They make a lot of money, and they also make a lot of money when the premiums for riskier securities are wide. And unfortunately for the banks, all of those things that they need to make a lot of money have not existed, except that's starting to change now. The fixed rate pressure has been relieved for them. In other words, the fixed rates are starting to go up, bond rates are starting to go up, and they can start making more money. And when they shift their mix of loans, they make most of their money from mortgages. When they shift that mix from fixed mortgages, which were very popular last year, to variable, they make more money on those variable mortgages. So their outlook is going to start getting better at precisely the time we think the market has overreacted on the downside to things getting tougher for them. So we think they'll be a good investment in 22.
Okay, and just very quickly, the big miners, BHP, Rio, Fortescue, all dependent on commodity prices, presumably.
Yes, and that's why they're very hard to invest in consistently successfully.
Yeah.
It's because you really do have to predict the iron ore price to know how they're going to go. They'll continue to make good money because they're some of the lowest cost producers in the world. So as the iron ore price falls, they'll continue to make a lot of profit. The problem is that their share price tends to be very correlated to the price of iron ore, and iron ore's been going down. In fact, Australian Treasury has a long-term forecast for iron ore of about $45 a tonne, which is still a lot lower than where it currently is.
Roger, thank you for talking to the Fast Five.
A pleasure.
That was Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. Well, Michael, you got tips for this year? REA sounds pretty good.
Yeah, well, I'm a terrible investor, so I'm just here furiously taking down notes as Roger's talking. As always, you should get professional advice before making any investment decisions. Thank you very much, Sean.
Thank you, Michael.
That's it for today. Make sure you've hit follow on the podcast. I'm Michael Thompson, and that was The Fast Five by Fear and Greed.